Ladies and gentlemen, after this enlightening presentation by Manoy, let us now turn to session 2 with a topic that is at the core of both modern monetary policy strategies and of the current inflation debate, inflation expectations. As you certainly all know, the narrative of many central banks nowadays, including the ECB, goes like this. By announcing a clear inflation target, the central bank anchors the public's inflation expectations at this target. If, for some reason, such as a pandemic, a war, a surge in energy prices, or disrupted global value chains, inflation surges temporarily, the central bank sees through the inflation hump. If and as long as the public's medium to long-term inflation expectations remain firmly anchored at the inflation target, that is, at 2% in the euro area. If, however, inflation expectations move away from the inflation target, then the central bank has to act. Before COVID, when inflation expectations were too low, the central bank responded with strong expansionary action. Now, in the post-COVID Ukraine conflict era, if inflation expectations were to rise above 2%, then the central bank would need to act again. In order to be on time, the central bank might indeed have to act even before such unanchoring of inflation expectation happens. Otherwise, bringing back inflation expectations to target would entail large lost output and unemployment. The Volcker recession of 1981-1982 is usually quoted as a reference. Now, this seems like a simple recipe. In practice, it is quite intricate for several reasons. First of all, what drives inflation expectations? I mean, we believe we know something, but we actually know, we do not know much more than we know, actually. And I think Michael is one of those who are at the frontier of research on these questions. Second, whose inflation expectations should we monitor? Professional forecasters, financial markets, consumers, firms, trade unions' expectations. There are many possibilities. And for some, the data are much better, so we have a certain bias as central bankers to look at those where we have the data. And for some other groups, the data are much more scarce, and therefore we don't monitor them incorrectly, in my view. Now, we have 3 excellent experts at our panel today to shed light on these and related questions. First of all, Pascal Blanqué, chairman of the Amundi Institute, will give a presentation on the psychology of inflation and money. Then, Geoff, head of section at the Monetary Policy Research Division of the ECB, will offer some findings from the ECB's Consumer Expectations Survey. And last but not least, Michael Weber, associate professor at University of Chicago, will talk about macroeconomic expectations of households and firms. So this is the last point that I referred to. As a co-author of Ulrike Malmendier, who was supposed to be on the program, Michael will also cover some ground of what Ulrike intended to present. Unfortunately, Ulrike cannot participate since her family is suffering from an acute wave of, guess, COVID. So without further ado, I hand over to Pascal, and I hope Pascal is online. Yes, you are.
Yes, I am. Thank you. Can you see me? Yeah?
Yes, we can hear you.
Okay, thank you. So good afternoon, ladies and gentlemen. So inflation has 2 main dimensions. It's a monetary phenomenon and a psychological one. So in my comments, I will try to address the 2 components that are highly interconnected. Let's start with the monetary angle, and my first proposition is that the quantitative equation of money is not dead, actually probably asleep. And actually consolidating the 2 aspects of V, the velocity, it worked in both the real and the financial spheres. So I'm starting from the famous MV equals PT, or V equals PT divided by M. I assume that there are 2 spheres. one real, the real sphere, the other one the financial sphere, and V is basically defined by transactions per unit of money, fueling either asset price inflation in the financial sphere or traditional inflation in goods and services in the real sphere. In the last 35 years or so, we've seen a high velocity of money in the financial sphere. Basically, imbalances have expressed themselves in the regime through asset price inflation, whilst trending low in the real sphere. And since the late 90s, the velocity of money has continued to fall in the real sphere, while accelerating again in the financial sphere, thanks to monetary and budgetary supports. So consolidating the real and financial spheres into a unique notion of V, let's call it V star. My point is that an inflationary process has effectively taken place. After all, liquidity is injected in financial markets in contemporary economies, and they can stay trapped at least for some time. Therefore, for me, V should be considered in both the real and financial spheres through transactions per unit of money. Higher or lower V in one sphere is coming at the expense of lower or higher V in the other, although sequences of simultaneous expansion of contraction in both can also happen. And in particular, if the means of payments allow to finance a simultaneous acceleration in both spheres. It seemed that inflation was not going to basically materialize due to the reduction in money velocity. This was the popular and consensual belief. In reality, widespread inflation has occurred in the financial sphere, and moving back, the jury is out, but moving back to the real sphere as a consequence of what I would call an ongoing regime shift. In particular, I think that powerful forces have masked, delayed, or blocked the return of traditional inflation. All of them are now reversing one per one, not least the role played by what I call the Chinese platform, but also the role played by the accumulation of FX reserves in Asia, in particular, as an interplay with the current US current account deficit, which was a peculiar feature of the previous regime. It has lasted a long time, driving the cost of capital interest rates in the West down. Actually, it's been taken as a structural forever. It has lasted quite long, actually, but I think we may discover that it was, after all, temporary, and that there was around some confusion between the so-called savings glut and simple money, actually accumulated at both ends of the axis between the US and the Asian economies, and central banks in particular accumulated FX reserves. Second remark, what's going on in my view today is a shift from a regime of financial capital that has lasted 35 years or so towards a regime more favorable to tangible assets and physical capital. These two notions being reflected by the two aspects of the I've mentioned. So this is for money. Then moving to the psychological dimension in relation to the comments I've just made. Inflation may become a self-fulfilling phenomenon due to psychology. And my second proposition here argues that the expansion of M, whatever the angle, monetary base, FX reserves, alone is insufficient to trigger an inflationary spiral. A shift in the psychological referential must simultaneously occur. So psychology and inflation are interconnected through psychological time, whereby, to take an example, time appears to fly during periods of inflation in the real sphere or in the financial sphere, actually. We had the experience. I've been the chief investment officer of Amundi for 17 years, and I can testify this flying time psychology typically in bubble territories. For example, 1 hour in normal times equals 1 day in hyperinflation, financial or real. And this work we've developed at Amundi, to a large extent built on Maurice Allais, the Nobel Prize seminal intuitions. This is my first comment. The second conviction is that the psychological referential I'm referring to is structured by duration, memory, and forgetfulness, and psychological time. And in particular, the link between long and short-term memory. Here we build on some intuitions of Herbert Simon back some years ago, and with the idea that inflation is a discovery process of memory, awakening, and adaptive expectations. People basically discount the future in the same way that they remember and forget, actually. So the discount rate, the psychological discount rate can be proxied by some rate of forgetting or when memory is back, which is another way to put it. And typically a sudden shift in data, for example, successively higher readings every month, builds up the short-term memory that brings the long-term reference back to the forefront. This is what happened, in my view, in the last year or so. And this is all the more important that perceived inflation, I stress perceived inflation, like perceived returns in the markets, are memorized variables with powerful hereditary effects, that is an influence of the past. As inflation persists and the experience of the past decade gradually fades, the market attention is turning, this is a fact in the markets, now to the long-term reference. The narratives are driven by references to the 70s, to the sub-components of the 70s, like stagflation, and the short-term inflation readings currently overshoot the long-term average by the widest margin since the 80s. And this, in the past, has been accompanied by higher inflation expectation. So this is, for me, an intrinsic element of the regime shift. The process is self-sustaining. There is inflation when people believe there is inflation. And this goes with powerful narratives in the psychological referential. And here, actually, I refer to Robert Shiller's hypothesis. They spread like a virus. Mathematically, they behave, the narratives behave like viruses, actually. And we are now, the new thing is that we are now able, for example, at Amundi, to track the narratives thanks to the recent developments in artificial intelligence. And there are battles of narratives. For example, you've got a battle between the secular stagnation, the roaring 20s. On top of this, we've got a fundamental role of collective memory. History, for me, does not repeat itself, but rather the psychology of people remains relatively constant. Few people today have a recollection of the great inflation in the 70s, and they have not been faced with any sustained period of rising prices. It's part of the challenge. The portfolio managers sitting at my desks actually don't know about what inflation is about. Actually, they have not been faced with rising rates or any sustained period of rising inflation. This is a discovery process where the rate of forgetting started at 1 maximum, actually, maximum. Think of the process as starting with a rate of forgetting maximum, maximo, and then progressively things are changing. And in particular, the longer the process and the longer the monetary components are downplayed or ignored, which is part of the behind the curve situation we are facing across the globe, the harder to fix the problem, in my view. The big historical core narratives we have studied are framed by a coefficient of forgetfulness. The further in the past the event, the greater the coefficient. But through sudden nonlinear jumps, a short-term event can revive long-term and dormant memory patterns which trigger inflation in the real sphere. This is likely where we stand today. In my view, the general public's collective memory is awakening and the expectations are revived. Narratives, I think, play a key role, and in particular in a world where medias and the spreading of news and information have increased significantly. They spread like viruses, I've mentioned, turning the narrative into a mass phenomenon with feedback loops and self-fulfilling prophecies. It is obvious today that references by various authorities to indexation, to blocking prices, blocking rents, are adding to the spreading of this kind of narratives. We are seeing a viral contagion of talks, narrative stories on TV, and the power of media is arguably bigger today than it was, actually, which is dimension of this psychological referential. It is also interesting to look at the inflation narrative, how they change between populations and experts, actually. It's now documented, and it's critical for central banks' action, clearly. There is a dichotomy now well documented. For an expert like us, an interest rate hike plays against inflation. On the opposite, an interest rate hike by the Fed or the ECB is perceived by some segments of the population as inflationary because basically to an extent validating the fear of inflation and having a psychological pro-cyclical impact. So this completes what I wanted to say on the two aspects very briefly, for sure. Let me finish with very brief comments actually on what's going on and seen from the window of an investor, the biggest in Europe, by the way. First remark, actually, what we've got the strong feeling of central banks behind the curve. In the case of the Fed, we've got some sympathy with the analysis of Bullard in the US, basically making some simple calculations, 300 basis points behind on the Taylor rule based, less so, but still behind using the forward guidance. Even more, we think that the reference with 74 and 83 is interesting. Last time the PC deflator hit 5.4, it was in February, was basically 74 and 83, two very different situations. And we've got the jury's out for sure, but we've got the feeling that we are closer to the 74 type of situation than the 83. In 74, the Fed downplayed the monetary origin of inflation, which is always a problem when you've got to take action then. They fell clearly behind. They acted very slowly and moderately. Real interest rates stayed low. Nominal rates increased. They bought time and nominal growth. Actually, ultimately, there was a price later to pay, with the markets doing the rest of the adjustments on the bond side in between. In 83, it was very different. We were already in the Bulgarian type of regime, and point by point, actually, it was very different as a way to think and act. Second remark, I think we are, at least seen from the markets or the investment standpoint, we are reaching what I call the end of the great monetary consensus. We've been playing markets and investors with a very easy to read framework, an independent model, one tool, one objective. I'm simplistic, but this is the way. And we looked at the markets with the Fed in the driving seat in the markets. This consensus is now severely fragmented. There are, I'm exaggerating, but there are as many reaction functions, at least perceived, as there are central banks, countries, or regions across the globe. And this is a fragmented landscape of real rates in the meantime. I've got my doubts, actually, on the nature of, I would say, the behind the curve factor, actually. I know there is a school of thought, it was a mistake, it will be fixed. Actually, I think the jury is out. It may prove down the road that it was not done by mistake nor by chance, actually, but it was actually reflecting a regime shift with an implicit preference for inflation building in the new regime in relation to various evolutions of the wider society and the fact that the previous regime, symbolically initiated by Paul Volcker some time ago, came to a close some years ago, and some of his aspects were rejected by the wider society. The third remark is monetary policy is over-commented today in the sense that must be seen in isolation. I think what is at stake is the dynamics of the policy mix, because we are at the end of the great coincidence of cooperative, accommodative, budgetary and monetary policies. It is obvious today that number one, the stimulus is behind us in terms of contribution to growth. So mechanically, public deficit should decrease, matched by a reduction in excess of savings of households and profits at the corporate level. Number two, there is a popular consensus for saying that there are critical needs to fulfill on the budgetary front in relation to energy transition in particular, but not only. And finally, there is a sort of consensus, academico-practical, to say that there is fiscal space to be used. My point here, actually, that there are various potential combinations of the policy mix moving forward. You can imagine various combinations of monetary policy and budgetary policy in this new context, with obviously various types of implications in terms of growth, inflation, and markets trade-offs. Number five, and we'll stop here. I think what's going on in the markets at the moment is what I would call a global repricing. It has started on the bond side. It's incomplete. Moving to the equities, the tech and growth side of the equity market, and more recently in the credit space, where we've seen some widening of the spread. What we are looking at in the investment community is basically the following. If you believe, as I do, that we have moved already into a new macro financial regime, whatever the name of this regime, the name of the game is to think hard about what what risk premia and valuations at equilibrium could look like in this new regime. It is clear to me that the risk premia and valuations at equilibrium we've seen in the last 35 years or so are no longer relevant to the current case. In this environment, the name of the game for investors is to preserve the purchasing power of the portfolio per unit of money, actually, which is a sign, clearly, and this is a strong consensus, which is a sign that the inflationary expectations, at least in the investment community, are already entrenched, since they are shaping the bulk of the strategies. We've got a problem of duration. We've got a problem of positive correlation between equities and bonds after 35 years of different type of correlations. In this context, actually, and I will stop here. Actually, the general view is that we are at a critical juncture. There is a temptation to think that we will be easily back to the Volckerian previous regime. Actually, I've got my serious doubts about this. Thank you.
Thank you, Pascal. We're now moving on to Geoff Kenny from the European Central Bank. Geoff will speak about inflation expectations, role, drivers, whose inflation expectations. So the title of this session. Geoff, are you in?
Yes, I am. Hi, Ernest.
Hi, good to see you.
Hello, everybody. Nice to see you too. I'm very sorry I wasn't able to join in person today, and unfortunately, I did experience a few technical difficulties earlier on as well, and missed a few of your introductory remarks to the panel. However, let me try and share my screen now. Looking here to find it. Let me also just say how nice it is to be here. I'm fascinated to be here today, and looking forward to the rest of the conference as well. So indeed, I'm going to talk about inflation expectations, role, drivers. I tell you, I am having difficulties sharing my file, but let me try one last time. If not, perhaps the organizers.
Listen, Geoff, Teresa is going to do it for you, and you just tell her next slide, okay?
Okay, sounds good.
Okay.
So in my opener, I want to talk about inflation expectations of households. And I'm going to draw on data and analysis from the ECB's Consumer Expectations Survey, which is a new survey that we launched in April 2020. If I could go to the next slide. Before we get going, I should say these are my own personal opinions. They don't necessarily reflect the views of the ECB or the Eurosystem, and I'm responsible, of course, for all errors. So I guess on the next slide, I highlight that the starting point for what I want to talk about today is, of course, recent dynamics of euro area inflation. And we plot them here based on the very recent data in the year to April of 2022. And I guess it's no surprise to the audience here today that we have seen very significant inflationary pressure in the euro area economy over the past year. A switch from a period of very low inflation, negative inflation, to inflation rates above 7% in the euro area in the year to April 2022. The key part of that has, of course, been the energy shock, which I've kind of taken out and put on the side of this chart just to highlight and bring into relief its magnitude, which is absolutely unprecedented. We're talking about nearly 40% annual increase in energy prices in the euro area in the year to April 2022. But it's not just energy. While the energy shock is extremely dramatic, also other components of the inflationary process have exhibited high dynamism, in particular food prices, as well as even excluding energy and food. We see rates of increase in other components, other core components, for want of a better word, that are above the 2% rate that is consistent with the ECB's target. So these types of inflationary pressures, which of course reflect major shocks that have hit the euro area economy over the past year, give rise to the question of whether this is going to be a very protracted or persistent development, or whether it's of a more temporary nature. And a key kind of element to that, I think we've heard discussions of this already this morning, is going to be whether or not the shock engenders a change in price setting behavior or wage setting behavior in the economy as a whole. And key to that question will be the evolution of inflationary expectations. So in the next slide, I zone in on one measure of inflation expectations that we have for the euro area economy, namely a measure of medium-term inflation expectations of households. Of course, we could talk about many different other measures, but I wanted to talk about households in particular today. And of note is that in the March 2022 Consumer Expectations Survey, you've seen a rise in the median inflation expectations of euro area consumers 3 years ahead, which is a very robust statistic. The median of these surveys has tended to be very stable, as you can see, over the period throughout the pandemic. But in the more recent survey in March of 2022, the months following the outbreak of the war in Ukraine, and in the months also following this dramatic price pressures that I just described in the previous slide, we have seen this increase in the median inflation expectations 3 years ahead, which is clearly something that needs to be very carefully monitored. And if you look on the right-hand chart here in this slide, you'll see where this has come from, basically. So we break it down in the cross-section. The share of households who are expecting different rates of inflation in the euro area or in their countries, and then we aggregate up across the euro area. And what you can see is a decline in the share of households that are expecting, reasonably modest rates of inflation close to the ECB's target in the range of 1%, 2%, and 3%, but an increase, a significant enough increase in the share of households that are expecting inflation rates at 4% and above. So in the next slide, it's clear that this situation of elevated inflation, current inflation, but also possible increases in more medium-term inflation expectations of households calls for enhanced communication with the public. In particular, given the complex nature of the shocks and this whole question about the extent to which the shocks are going to engender a more persistent versus a more transitory evolution of prices, and the question of enhanced communication with the public comes very much to the fore. And I want to kind of show you some results in my remaining slides based on analysis that we've done with the Consumer Expectation Survey that points to the potential benefits of increased and enhanced communication with the public. This is a very challenging endeavor because the public is very hard to reach. And you can see on the left-hand chart here, where we've taken the example of last year, following the ECB's strategy review outcome, where we had an announcement about changes in the ECB's monetary policy strategy. So there was a lot of publicity around these changes in the monetary policy strategy. And yet you can see that a majority of households did not hear about the ECB after its strategy review announcement in July of 2021, both in August and September, which were the 2 months we considered following the announcement. Another aspect that you can see is that those that did hear, they mainly heard through traditional media channels, through TV and radio, and newspapers and magazines. There's far less information gathered by households about the European Central Bank from other more online channels like websites or social media. So in the next slide, I want to describe to you this work that I've undertaken with colleagues from the ECB, Michael Ehrman and Dimitris Georgarakis, where we asked the question, can central bank communication enhance credibility? And we do this using an information experiment, where we take a randomized subsample of the Consumer Expectations Survey as a control group, and we provide it with no information. And then we take 4 other treatment groups, randomized samples again, so comparable in all other aspects to the control group, but we give them some information about different elements of the ECB's communication related to its new monetary policy strategy. So this setup allows us to test for the causal effects of information treatments relative to the control group on central bank credibility. And in doing this, we use a new measure of credibility, namely we measure credibility with respect to the ECB's primary objective of maintaining price stability. And we ask the respondents to the Consumer Expectations Survey, how likely do you think it is that the ECB will maintain price stability in the euro area economy over the next 3 years? And then we can, as said, test the causal effects of the different information treatments relative to the control group. So in the next slide, I start to summarize the information that we provided. The first was one of the main announcements of the strategy review, namely the announcement related to the inflation target of 2%, and in particular, the information about the target being symmetric and having a medium-term orientation such that persistent negative and positive deviations, the ECB can see through short-term deviations, but persistent negative and positive deviations are regarded as equally undesirable as a result of the symmetry of the 2% inflation target. Then in the next slide, I show you the second information treatment, which is basically the information about the symmetric target plus a further explanation about the function that that target plays in the monetary policy framework. And in particular, that refers to the stabilizing role that monetary policy can play, also that it has significant favorable effects on economic growth and employment. So this further explanation of the role of the 2% inflation target in creating space so that monetary policy can have this stabilizing effect is the additional marginal extra information that the second treatment group receives. Then in the next slide, I describe the third information treatment. And that includes, many of you will recall, of course, that climate change received considerable attention in the ECB strategy review. So here we have added the information that the ECB decided to explicitly account for the implications of climate change and the carbon transition in its new monetary policy strategy. Now, on the one hand, you might expect that this is going to improve credibility in the sense that taking into account something that is having real effects on the economy, potentially affecting price and inflationary pressures in the economy, is certainly a wise thing to do. On the other hand, of course, there is also the idea that has been expressed in some constituencies that giving greater attention to major challenges like climate change could also weaken central banks' perceived credibility of hitting its price stability target, linked to ideas like mission creep and so forth. So again, it's not clear a priori which direction this would go in. And then in the final slide, I tell you about the fourth information treatment, which links to housing costs, which are seen as particularly relevant for households, of course. And as an outcome of the strategy review, there was the promise to take more seriously the idea of having a broader coverage of housing costs in the measurement of inflation, and that the ECB would work towards making this possible. And of course, as we've seen also, there have been quite some pressure in housing markets as we have come out of the COVID-19 pandemic. But again, this is a commitment or a promise to take into account housing costs in a better way in the inflation measurement. And again, one would argue that a priori, it's not so clear, is this necessarily going to improve the credibility of the price stability objective? So these are the information treatments that we look at. And in the next slide, we show you our main results, where we analyze the causal effect of communicating about these issues with the general public. The key result that you can see in the first two columns of this chart is that communicating about the symmetric 2% target improves the credibility of the price stability objective over a 3-year horizon. And in particular, as you can see in the second column, the blue bar, adding this further explanation about the function of the target and the stabilizing role of monetary policy has the highest credibility gains, according to our analysis. And then finally, what you see in the last two bars, the treatment that includes climate and housing have no additional credibility gains. But as I mentioned earlier, they also have no losses either. And again, I recall this idea of mission creep that has come up in the context of discussions relating to climate. We don't see any loss in credibility associated with the climate treatment either. In the next slide, a key issue relates, of course, to the public is very heterogeneous, and we split our respondents between those who have, above median levels of financial literacy measured according to standard methods in the literature, and those with below median levels of financial literacy. And what you can see is that the results that I just described to you are mainly driven by the respondents to the Consumer Expectations Survey with high levels or above median levels of financial literacy. The results are much weaker for for consumers with below median levels of financial literacy. But it is nonetheless interesting to note that the blue bar for low financial literacy, which is the treatment that included also the explanation about the stabilizing role of monetary policy, does have a significant and positive effect on credibility. And it points to the need to really explain, particularly to the below median households with below median levels of financial literacy, the role of the target and this stabilizing function of monetary policy. So in the last slide, I just summarize. I hope I have stayed broadly on track, Ernest, in terms of my timekeeping. But I decided to put the emphasis here today on this question of communication with the public. It's clear, of first order importance is, of course, the calibration of the monetary policy stance in the light of the evolving economic situation. But nonetheless, the elevated current inflation and the complexity of recent price shocks highlights also the importance of first a stability-oriented monetary policy strategy, but also a strategy that is effectively communicated to the public. And the evidence that I've shown here today shows the potential of such communication. And in particular, we've shown how communicating the key elements of the ECB's new monetary policy strategy can help improve credibility significantly. It points to the benefits from, in particular, communicating the symmetric 2% inflation target and providing broader explanations linked to the stabilizing role of monetary policy. We also get different and divergent effects comparing financially literate with less financially literate households. And this is something that needs to be taken into account in devising such communication strategies. In particular, one needs to think about targeted forms of communication that take into account these differences. And this result also points to the need and the potential benefits from promoting financial literacy also over the longer term. So with that, Ernest, I would conclude and look forward to the rest of the panel discussion.
Thank you very much, Geoff. We now broaden the perspective a little bit and continue with this analysis of expectations, and now broaden to households and firms. And Michael Weber will give us, I think, a very good overview.
Given that I'm so short, I'm actually standing next to it, otherwise you don't see me. Anyway, so thanks a lot for having me in this panel. And indeed, so I would directly actually want to answer Ernest's questions, whose expectations should we focus on, at least like to the extent, and can you actually show my slides maybe? Okay, perfectly. So slides are here. Actually, given that Geoff had a disclaimer, let me also make a disclaimer. So what I'm talking about is my personal view. Hopefully it is positively correlated with the view of my co-authors, whose papers actually I'm talking about today. And so to come back to the intro question of Ernest, whose expectations should we focus on? If you think about the US, 2/3 of GDP is consumption. Investment is the most volatile part of it. I've never seen a model that actually has professional forecasters in there. Financial markets, if at all, only indirectly matter for the macroeconomy, and so therefore, or consumption investment. So therefore, we actually ultimately have to understand how firms and households form expectations. Now, what I want to do today first is actually talk about the household side, and then come back at the very end to the firm side and actually show you that in the end, most of the things that actually are true for households also actually matter for firms. And to the extent, why should we care about households? I've simply the consumer Euler equation, ultimately, here the Fisher equation first, and then through the consumer Euler equation, if you and I, we all face the same nominal interest rates, heterogeneity in our inflation expectations matter to the extent actually they shape our perceived real interest rates. And then there's now very robust evidence that, perceived real interest rates matter for consumption savings choices, for mortgage uptake, fixed versus adjustable rate mortgages in the US, stock market participation. In some current work with Kobior, Gornichenko, and Dakunto, we actually show they also causally matter for wage expectations, labor supply decisions. And then, however, which is maybe a little bit challenging for central banks, if you then actually try to see whether wage bargaining and wage expectations would react in a causal way to announcements of policy rate increases, you just see, and this actually echoes what the first panelist said, households actually don't react to that, at least directly. And so now what is the typical policy narrative? To the extent now expectations are well anchored, movements in nominal rates transmit directly into movements in real rates, and then all those mechanisms should be operative. But actually, even in times when actually you can no longer potentially move nominal rates, to the extent you can still move around inflation expectations, you could still potentially steer aggregate demand. Now the question is, are consumer expectations well anchored? We asked that in 2018 in a paper that is now forthcoming next month in the Journal of Political Economy. We asked, what do you think is the inflation rate the Federal Reserve tries to achieve over longer periods of time? And there are some people that have maybe well anchored expectations. You see, however, a whopping 40% of a sample of 25,000 Americans, as representative as they can get, expected or perceived an inflation target of 10% or more. At least the way the Fed seems to communicate, is maybe not effective, currently at least, to anchor households' inflation expectations. This, of course, doesn't mean that those expectations are pure noise, because we do show that if you are able to reach them through an information provision experiment, people shift their expectations to information provided, and then crucially, they also change their consumption pattern in line with the consumer oil equation, not only within survey, immediately afterwards, after 3 and 6 months, but crucially, in that panel, we observed for 50,000 Americans via home scan data, what they purchase, where they purchase it, at which prices, and they also shift their actual purchases in the 6 months afterwards. Then actually there's not only like a general upward bias in inflation expectations as you saw earlier, there's also, based on observable characteristics, systematic heterogeneity in inflation expectations. This goes actually back to 82, a paper by Jonung for Sweden. And here we see, like, just downloading the data from the New York Fed survey of consumer expectations between 2011 and 2018 collapsed by gender. We all recall we were struggling hitting 2%. You see that everyone is upward biased inflation expectations, but the upward bias is substantially larger for women than for men. Now the question, why is that? So here this is across households. What we did in another survey with Ulrike, who cannot be here, and Francesco da Cunto in the proceedings of the National Academy of Sciences, we were able to elicit inflation expectations from the female and the male household head. Within same household, is there a difference in inflation expectations? Of course, we can keep constant lots of things, housing choices, family structure, household income, and so on. And even within households, in the left panel, you see that women have about a 0.4, 0.5 percentage point higher expected inflation rate over the next 12 months. The only thing we do in the right panel, we split our sample households into households in which the male household head declares to never go grocery shopping. That's the left panel here. And that's a panel where the male household head who at least partially participates in daily grocery shop. And you do see that the whole difference is driven by what we call traditional gender norm households, where the husband never goes shopping. Instead, actually, where at least men are partially exposed to grocery prices, the volatile prices when grocery shopping, you do see that actually men have no different expectations than women. And it is because the men's expectations also move up. So it looks like somehow being exposed to grocery prices in their daily lives actually leads to an upward bias in inflation expectations. And then, of course, you can just ask people, what are the sources of information you would use when you actually form inflation expectations? To some extent, it actually goes back to the old idea of the Lucas Island model. We sit in our own little shopping islands. We use the prices we observe in our daily lives to form expectations of overall price. And in fact, that's actually what's come out of the data. Predominantly, 3 most important, 2 second most important, 1 third most important. The most important source of information for ordinary Americans, 50,000 households in that survey, is their own shopping experience. Then you see, like, family and friends are important and so on. Maybe newspaper, at least in the US, not so much. So it looks like somehow being exposed to prices by real preferences, or also in the previous slide, makes you actually form higher inflation expectations. So we went back actually to what I said earlier, given that we do observe for many, many years at the daily frequency what individual households purchased, what the prices they paid, whether they used coupons and so on. We were able to measure at the individual household level what the realized inflation rate over the previous 12 months was. So what the BLS would be doing, but for a household-specific bundle. To the left here, lowest realized inflation. To the right here, highest realized inflation over the last 12 months at the household level. You again see a general upward bias here. And then if you ask them, what do you think is the inflation rate for the overall US economy over the next 12 months? And if I realized high past inflation, I expect way higher overall US inflation compared to someone who has low realized inflation. Now you might say, maybe people just forecast their own inflation. Well, the reason why we typically strip off grocery prices, energy from core inflation is because they're quickly mean reverting. So if you were to look whether maybe those people are better able to forecast their own expectations for their own bundle, the realization in the next 12 months, that's not the case. Because if I had high past inflation or low past inflation going forward, we're just equally likely to have high and low household level inflation. So it looks like that people use the signals in their daily life to form overall expectations. What you don't see here on the slide is there are two crucial additional ingredients that we show in this paper. People also especially focus on goods they purchase frequently. We just had an op-ed this morning in the Frankfurter Allgemeine Zeitung exactly about that point. And crucially, they also weigh positive price changes more by a factor of 3 relative to price cuts. I'll come back to that, what this means actually for the current situation in the conclusion. And then, going back to this idea that frequently purchased prices matter actually way more, you can just ask them, are there some goods that typically come to your mind when you form inflation expectations? And what you see is the price of milk is actually very prevalent, the price of gas, the price of bread, survey in the US, if it was a survey in Germany, maybe for men, there would be a higher bar here. But all I'm trying to say is those things people see in their daily lives really, really matters for how they actually form inflation expectations, which of course on the flip side means if I now see an initial price impulse in a category that is very salient to me, I might immediately update my overall inflation expectations. And that's to some extent at least what happened in the US. Rental car prices spiked up a lot. You saw that grocery prices went up a lot. And initially, in April 2020, inflation expectations went up. Last summer, they went up even higher. So those initial price impulses in narrow categories led to an overall increase in inflation expectations. Now, actually, to kind of motivate why I will argue that policy complexity and simplicity matters a big deal, we went actually for a paper which is in the Review of Economic Studies to Finland, because in Finland you can pretty much observe whatever you want about an individual. And here we were able to observe for the overall male population their measure of IQ from the military, their subjective inflation expectations over the next 12 months, their tax income, and so on. And then the only thing we are plotting here is what do people think inflation will be? Then we move forward by 12 months and look at what inflation was. That's now what I have on the y-axis, the difference between my forecast and what is realized. And on the x-axis, I simply sort households based by a measure of IQ we get from the military. And what you do see is there's a systematic, so everyone is upward biased, but there's a substantially larger bias for the bottom part of the distribution by cognitive abilities to the far left, relative to those with the highest cognitive abilities in actually Finland at least. Now what I show you later on is that, the higher cognitive ability people, they actually tend to be those that do react to economic policies. Now of course on the flip side this means if you actually don't explain well what you do, why you do it, and what actually the intention is, you might have regressive policies and implicit redistribution from the bottom to the top part of the IQ distribution. So this is from some paper that we published recently in the Review of Financial Studies. So here we just actually try to compare two policies in Germany that at least theoretically, through the lens of the new Keynesian model, would operate exactly identically. The left policy is Mrs. Merkel, when she was first elected in November of 2005, went out and said, in 14 months' time, in January of 2007, we'll increase value-added tax from 16 to 19%. If I tell that to my dad, he understands, before prices are higher, I better go out and purchase a new car. And indeed, you see in the top panel for Germans, before actually the tax went up, inflation expectations are higher, tax is implemented, they come down again. And what is their willingness to purchase larger ticket goods? Indeed, they nicely go up and go down, as my consumer Euler equation would predict. The right panel, the first two announcements by Mario Draghi to keep interest rates at current or lower levels for an extended period of time in July of 13, and in January when he firmly reiterated, again through the lens of the new Keynesian model, inflationary in the future, I update today upwards my inflation expectations, go out shopping. Neither did inflation expectations move, nor did actually durable purchases move. So a policy that maybe we as academics didn't even know might actually have shortcomings, certainly for ordinary Germans at least, also didn't work. So it really looks like the complexity of a certain policy matters to the extent to which ordinary consumers are aware of it, react to it, and understand its implications. There we are. We missed a couple of slides. Somehow the clicker doesn't work anymore. Could you maybe, there we are, okay, perfect. And so then to actually dig a little bit deeper and to kind of also be more able to make actually causal statements, we went back to Finland and did one of those information provision experiments you heard by the previous panelist. And we actually provided simple messages like, the way we set it up in this paper, we kept constant the sender of the policy communication, Olli Rehn. We kept constant the policy medium, his official Twitter account, and what we varied was the content. One message was, Finns, don't worry, we'll do whatever it takes so that the pandemic doesn't hurt you. The second message was, the ECB just actually passed the large-scale asset purchase program over a huge number, and then we just simply ask Finns, to which extent do you actually think this policy will be beneficial for Finnish households? 7 means very beneficial, 1 means not beneficial at all. And you see that keeping constant the sender and the medium of the message, content really matters. And Rehn just saying, don't you worry about the exact little details. We'll do whatever it takes. It's very successful in raising the optimism. And in fact, they increased also the income expectations. Instead, policies that are way harder to understand by ordinary Finns didn't really work all that well. And so here I want to just show you that also the policy medium matters. Now I actually understand what you meant earlier, you're here in the limelight. So like here we just, in this paper with Colloquium and Gorodnichenko, we just actually did send random messages to different subparts of the population in our survey to see how they would update their inflation expectations. The message was identical, but the way we send it was actually different. One was through an official policy release, the other one through the newspaper, the third one was by a speech and so on. And what you actually highlight 2 numbers here. So ex ante, everyone was too high, and so what you want to achieve that people adjust downwards their inflation expectations. What you see is like if you force people, and of course this is the big if, people had to read the statement. If you actually have a credible source, they react a lot. Instead, to the same numbers, the USA Today statement coverage at the inflation target, current inflation, and the inflation outlook, you do see in the US at least, people systematically discount information through official newspapers, and we showed that in the US setting, it is because newspapers are just not trusted anymore in the highly polarized environment. And so in the last point I want to make here is just that also, so not only does like the medium through which information is sent matter, the message matters, but also the sender matters. In some recent work with D'Acunto and Andreas Fuster, what we actually show is through a simple information provision experiment, again, you just simply split your survey population in different groups, a control group, different treatment groups, and what we keep constant in that setting is we provide all the same forecast. The Survey of Economic Projections predicts for 2021 an inflation rate of 1.6%. By the way, they were pretty far off, obviously. And then what we differ is the picture that is associated with the same forecast. Mary Daly, white woman, Raphael Bostic, black man, and Thomas Barkin, white man, all 3 regional Fed presidents, all 3 alternate members on the FOMC, all 3 contributed the forecast to that very Survey of Economic Projections that we use. And now, this is way too complicated in all to explain in all detail, but what we show is that women and black survey participants were way more likely to incorporate the provided forecast into their own expectations, and subsequently, they expressed a higher level of trust in the Fed to actually ensure stable prices and high employment, and also to care about the well-being of all Americans. And now just to go back to our discussion of, our expectations well anchored. I showed you earlier, short-run expectations of 1 year ahead. And you could say, well, temporarily because of shocks, they might move around, but to the extent that long-run expectations are well anchored, it might still be able to claim success. For households, at least, when they update their short-run expectations, 1 for 1, they update their long-run expectations. What we are doing here is just the forecast revision within individual from this month to next month, for the long horizon, 5 years ahead, and for the 1-year horizon, again, within individual, how do people update their expectations? And you do see a very tight link. If I update my short-run expectations, I also update my long-run expectations. So the idea that long-run expectations are fixed and only temporarily we see deviations doesn't seem to work out in the data. And so this is the last chart to go back to, who should we care about? Of course, like as Ernest alluded to, we might care a lot about price setters in addition to consumers. There's, of course, way less good data than for consumers. That's why I focused on consumers today. But if you look at survey evidence that we discussed in a recent Journal of Economic Perspectives article, you do see in black the short period for which we have firms that don't differ all that much from households. And so therefore, our idea is that what we've now have seen over the last couple of years being documented for households most likely is also relevant for firms. So to the extent you are interested in this line of work, we've written 3 recent kind of review chapters in the handbook, in the Journal of Economic Perspectives, and for the IMF Economic Review, where we discuss in way more detail what we so far know for expectations. And let me wrap up. I think I went slightly over time. And so what I wanted to argue today is that we should care about household expectations. Households, however, differ very much from economists and central bankers. The way they form expectations, they focus on specific goods, they focus on salient price changes, they overweigh positive price changes. So therefore, we already saw huge spikes in consumers' expectations earlier in the pandemic and again last summer. Of course, the flip side then also means even if now central banks are able to immediately tame realized inflation, it will still actually take quite some time for household expectations to come down because households pay way more attention to price increases relative to price cuts. Thank you.
Thank you very much, Michael. We have a couple of minutes for any questions that you may have. Yes, please. David.
Yes, David Marsh here from OMFIF. I was very struck, Geoff Kinney, by your presentation. Thank you very much for that. I hope that you are still online somewhat. You've obviously done a lot of work on this, and people are very interested in this new form of forecasting that you're coming up with, the CES. But you seem to neglect in your statement the basic question of how credible is the guidance from the ECB in general. You gave us all these figures about what happens if you give a bit more explanation. It seemed to increase the credibility by about 2 or 4 percentage points, i.e. not very much, one might think, within the realm of error. Can you just tell us the basic question, how credible are the ECB's statements and forecasts about the inflation rate in the future in general? And then that would actually allow us to make a bit more sense of all those very fascinating iterations that you gave us.
If there is no further question in the room, then I have one from the chat that I wrote down from before, which is linking the presentation by Manoy and the topic of inflation expectations. So to the extent that someone believed in your medium to long-term forecast, to what extent might that in itself affect inflation expectations? The usual stylized fact that we as central bankers know is that short-term inflation developments influence short and long-term inflation expectations. But also such long-term trends, if people understood them, might bring inflation expectations on an upward trend. Yes, please. 2 further questions back here, and then we go ahead.
Thank you. Franz Tobel, RBA. I have 2 questions, one to Geoff, one to Michael. They're a bit related, but Geoff, I was wondering, you showed that the median household expectation were prior to the war in Ukraine quite well anchored at the 2% level, while we heard for the US that there's even the expectations to be inflation target of 10%. So do you have any idea where this difference comes between the euro area households survey data and those of the US? Second question to Michael. What would be your monetary policy implications? I mean, Ernest motivated this whole panel that central banks can look through supply-driven inflation shocks because long-term inflation expectations stay put. Now you told us that even specific commodities like milk and gas influence not only short-term expectations, but also medium and long-term expectations. So yeah, I think what should we learn from monetary policy from this? Thank you.
Final question here.
Okay, Michael, ready for questions. We'll briefly discuss that during the break. So household, respond differently depending on their exported grocery price and so on. So the answer you get then is not their expectation for aggregate inflation. It's something more like if I shop a lot, it's something, I think the inflation expectation for my grocery price, right? So when you aggregate them up, so what do you get? I mean, how do you interpret that? So, okay, Geoff, question for you is, from your RCT, I would expect those households with lower education, they should benefit the most from your information treatment. But the result you guys seem to say the opposite. Thanks.
Michael, do you want to start?
Yes, regarding the question from the chat, to the extent people were aware of those long-term trends and they were salient and credible, so you could expect that they would react to it, because we do see that throughout many of those survey information provision experiments, that to the extent people perceive information as credible, they do adjust their expectations. Now the thing is, oftentimes the biggest challenge, and this actually goes back to why we think that expectations sometimes are so wild, is that most ordinary households, especially in times of low realized inflation, they're rationally inattentive. So it really takes quite a bit of work on the side of central banks to pierce the veil of ignorance through clear communication, to make it vivid to households, what a central bank tries to do, what its objectives are, what price stability means. Earlier at lunch, we actually talked a little bit about what the Bank of Jamaica has been doing with their reggae songs about price stability and what an inflation target is. It's I discussed a related point, I think, in October 2019 at a Brookings panel, and the president and CEO of the Cleveland Fed, Loretta Mester, was in the audience. And given that I'm also an economic consultant to the Cleveland Fed, I know that they had discussions internally to actually record rap songs between her and LeBron James. Could imagine a 2'10" guy and Loretta rapping about price stability. And so the thing is, what I want to say is you have to the extent you do care about ordinary people being well informed about monetary policy, you have to convey it in such a form that they actually want to listen and learn about it. Most people in their day-to-day lives, they actually couldn't care less who currently is the head of the ECB, of the Federal Reserve. You ask people who is the president, who is the head of the Federal Reserve, and they tell you Alan Greenspan. So clearly, the current way people focus and care about monetary policy is not actually a way where people would actually pay that much attention. Now, and I guess you might say the monetary policy has been very successful in the last couple of decades. And the question then is, maybe we shouldn't care about households' expectations. Maybe they are not informed, and that's good, and people don't care about what the Fed is doing, and to the extent inflation is low and stable. But then you potentially run into an accountability and credibility issue. And so Madame Lagarde, when she had her hearing in front of the European Parliament, she made this point very clearly. She said, ultimately, we serve ordinary Europeans. We actually are granted central bank independence to the extent that we actually have a high level of trust by ordinary people. So I think we have to find ways to actually communicate with ordinary households. And Geoff showed actually there is potential scope. We in our work show that. So I think it just is a question about what is the way to best actually reach out to people. And the Fed listens events, what the ECB is doing, there are definitely ways, but we have to find ways on a larger scale to do that. Milton Friedman used to be on TV and convey why actually capitalism is the best system. Maybe we should actually also reach out to central banks to do that.
Thank you. Geoff?
Hi, thanks Ernest, and thank you also to the audience for their their questions. So there was a question about our numbers on the credibility, which refer to this new measure that we have used in the recent survey, the how likely it is that the ECB will achieve price stability over the next 3 years. And we actually think that this is a good way to measure households' perceptions about a very important issue, particularly at this current juncture, where we talk about all the uncertainties that exist in relation to the inflationary process. But it has the virtue as well that it's not particularly anchored. It's a very open question. How likely over the next 3 years will there be price stability? It's going to a certain extent, be influenced by people's current perceptions about inflation. And I mean, to answer David's question, I mean, to me, it's very clear in the case of households, they have less well-anchored inflation expectations compared with other agents. It's a very dispersed distribution. Michael showed more of this than I actually showed in my presentation. But in one of my slides, you can see we report the mean and not just the median of the 3-year inflation expectations. And you can see that that sits quite a bit above the median. And this, of course, reflects the wide dispersion in inflation expectations amongst households, which points to the very fact that they are far less anchored than the expectations of professional forecasters or indeed market participants. And the reason for this relates to one of the other questions that we had, namely that the responses to these surveys are picking up not expectations about some common homogeneous aggregate inflation measure that is normally what you get from expert surveys, but it's picking up, as Michael showed, the kind of subjective inflation experiences of individual households, and it complete with all the behavioral and other heuristics that may generate those expectations. And as we continue to study these expectations, we're learning about, their properties. And I think what we're learning is really putting a big emphasis on the need for enhanced communication, particularly, for example, at a time when we have a large inflationary shock and where there's considerable uncertainty in terms of how persistent that will prove to be. For example, there is a need to explain the factors that will help alleviate the inflationary pressures over time in such circumstances to households. But to answer also specifically David's question in relation to the numbers I showed, so this, how likely it is that you will have price stability over the next 3 years, this number is in around 46, 48%. So it's less than 50%. And the changes that we show, which I showed were significant, make it more likely that there would be price stability over the next 3 years. But it's really the delta in our analysis that points to the clear potential from communication. Thanks, Ernest.
Thank you very much, Geoff. I think we've run out of time. We've used it very well. Thank you, Pascal, wherever you are, Geoff and Michael, for the many insights that you shared with us. I think I can say that there are lots of interesting findings on inflation expectations. They are far more complex than one might think. There is a big ongoing research agenda. There's still a lot more to learn. May I refer you to session A tomorrow morning at 9, which will deal with inflation expectations in much more detail. For now, I close for the break. Please be back at 4:15 for the policy panel with Robert Holzmann, Andrew Bailey, Joachim Nagel, Claudio Borio, and Tobias Adrian. Thank you very much. See you later.